Good afternoon, ladies and gentlemen, and welcome to the Trident Royalties investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will send you an email to notify you when they're ready for you to review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll, which if you could give that your kind attention, we'd be most grateful. And I'd now like to hand over to Adam Davidson, CEO, and Martin Page, CFO from Trident Royalties. Good afternoon to you.
Thanks, Mark. Appreciate it. And thanks, everybody, for joining us. Hopefully it's informative, and the intent is that this is interactive, so we will try to answer all questions as we can, and feel free to drop them in as we go, and we'll tackle them at the end of the webinar. And the intent of this webinar, obviously, we've got the AGM upcoming, and we will be able to address some questions at the AGM, but we thought it would be helpful for shareholders, particularly as we've got quite a few new shareholders, to be able to give an in-depth overview of what we're doing, where we've been, where we're going, and to be able to tackle some of those questions. So we thought it was a good chance to be interacting with our shareholders, which is an important thing for us to do. And speaking of, I guess, where we've been and where we intend to go, before we jump into the presentation, we've spent some time internally reflecting on both those topics. We listed almost exactly 12 months ago from today, so we're pretty pleased with our progress thus far. At this time last year, we were a $4 million shell company. We're now a plus $100 million royalty company. We've grown from 2 employees to a good management team of 4. We went from one royalty when we launched this time last year to now 12 royalties, 2 of which are paying, a third in construction, and then Thacker Pass sort of heading briskly towards commencement of construction next year. So really pleased with the way the portfolio has grown. And then I suppose most importantly for shareholders is when we launched the IPO price was 20p a share, and today we're sitting around 40p a share. So we're seeing sort of the uptake in both share price, and then importantly for a healthy share price, good liquidity. So we've got investors able to get in and out of the stock as they want to. So we're pleased with the progress thus far. Happy to provide this update, and I will turn it over to Martin Page, who will jump into the first couple slides.
Yeah, thanks, Adam. As you say, I guess we've done this presentation a couple of times, but we appreciate especially in the last couple of weeks, the share price has done pretty well, and we know there's a reasonable amount of new shareholders come onto the register. So for those guys out there that maybe haven't heard the mining royalties 101, I guess, that we have at the beginning of this presentation, I'll take you through the key points before handing back to Adam. I guess, yeah, for those who I'm fully up to speed in terms of what is a royalty, it's very much like you have in the music industry. It's effectively a percentage of revenue, that entitles the royalty holder to a percentage of revenue, either into perpetuity or occasionally on a capped basis. I mean, royalties come in all shapes and sizes, from deferred to stepped, but ultimately it's focused on that top line. And how do royalties come into our hands, I guess, as a company, is an interesting question. There's 2 primary ways. One is through a financing process, often called a primary process, whereby the actual mining operator or developer needs some finance for, I don't know, I guess doesn't want to necessarily go to the market for an equity purpose. I think when we go into the portfolio, we can point out which one's been a primary royalty and which one's a secondary. Or it's an operator who's up and running but could do with a bit of extra cash to improve the plant process, or just a slight shortfall in working capital. Maybe the grade's down a bit, or whatever. But ultimately, that's a primary financing where you're dealing directly with the operator. There's a secondary market out there. I mean, huge amount of, obviously, mines out there, and pre-development mines and exploration properties, and vast majority of those at some point back in the distant past have changed hands, and quite often during that process a royalty is put onto that land, either just for the person selling it may wish to keep a bit of royalty for the upside. They may, and as I say, or often it's someone who's previously financed at the primary stage, but no longer wants to hold that royalty. Often we have some mining funds where their fund is a closed fund, so coming to an end, and they're looking to monetize that asset. And again, that's a point where we can enter in negotiations and buy that royalty. Often with those types of royalty, you have less involvement with the operator. The actual purchases between the holder of the royalty at the point and ourselves. So what's the key benefits of royalties? I guess this is often should be seen within the realms of what's the benefit compared necessarily to equity or debt holder. I guess the first point on that slide is that it often ranks senior to a number of other capital structures. So it sits on the land. So should something go wrong, and the operator failed, it still sits at high security point on that, and will retain, and the royalty will be retained into another project should that come along. I guess the key bit we often push is that the revenue is obviously the top line, so we're very much exposed as long as the asset doesn't get into become uneconomic and go into problems. We'll always get paid, whereas those equity holders who maybe the costs go up, or they're hitting a grade problem, or I guess some are successful and they raise, they have a pot of cash, but they want to go and make some M&A transactions and use that cash to grow as a business. You're not necessarily getting, as an equity holder, the upside there, or other than potentially the share price improving, but ultimately as a revenue percentage, you will always get have the income direct, and alongside that also got the upside from the commodity prices. But in current markets, this is certainly the case, and acts as an inflationary hedge. The current markets the central banks have been printing cash, so I think at the moment this isn't a bad holding actual assets, real assets, is a good inflationary hedge. The other upside, and we'll touch on in a couple of slides, is that royalty companies certainly seem to be trade at valuation multiples. Holding a number of royalties across a suite of commodities and a range of jurisdictions reduces that portfolio risk. Whereas I come from a operating background. I was CFO at a number of gold mining operators in West Africa. My last one was a single asset in Senegal, so an excellent asset, produced a lot of gold, and we had a very successful exit. But there's always those slightly nervous times. If there's an issue in country or an issue with the plant, it can become a bit nerve-wracking, and that's passed on in some ways to the share price and to that valuation. So this idea that we have a slightly de-risked portfolio from a perspective of having a commodity or a range and a jurisdiction range, that certainly helps these multiples, and we'll show you a graph on that shortly. Scale and diversity, certainly, I think it's clear if you look at some of our peers as we grow. I mean, we're still, as Adam says, we've gone from 4 to 100 million market cap. We've gone from 0 to 12 royalties. We still feel like we need to grow to just show that diversity, one of revenue, and just to spread the risks, show that should something happen with one of the royalties, you're covered on 10, 20, 30, 40 other royalties, so that it's less of an impact. So that's a clear upside as we grow. And the final point is the ability to utilize lower cost leverage as we get a bigger size, and we get to be more revenue production, where we can service a low cost debt vehicle. It will help us, having a nice big ticket of in terms of a debt facility, where we can utilize that for quick deployment into acquisitions, and we're not diluting the shareholders. Okay, so that's a reasonably quick 101 on the royalties, what it is, 101. I think this is tied in with what I was saying in terms of these multiples. I mean, we're using the aspirational companies here in terms of Franco-Nevada, Wheaton, and Royal Gold. I mean, some of the bigger names in the sector, but it just shows that how they've outperformed just the standard gold miners, for example, over the last 15 plus years. It's certainly clear that there's the market appreciates this diversity and portfolio spread of the risk compared to, even some of the bigger mining. Something like Barrick has 5, 6, 7 tier 1 assets, and they're very much focused on that. But these guys have multiple tier 1 assets that they have royalties over, and that's reflected in their performance. Okay. So I guess we get asked this question a reasonable amount in terms of why Trident? What do we see as why did Adam and the board and the initial shareholders see as an opportunity? And I guess if you look at the pie graph on the right hand side, that was the primary focus in terms of this. What can we provide as a company that a number of the other companies don't? So the idea came out that we would focus on the global mining sector in terms of as a spread, rather than being very much focused on the precious metal guys, which is the graph below. Ultimately, we don't have any restrictions in terms of jurisdiction other than ones that we think are pretty politically dangerous. We think we don't do anything in terms of thermal coal. But other than that, we will look at we want to be a third approximately, which reflects this mining sector. So from the base metals, your copper, zinc, tin, lead, nickel, through to precious, obviously gold and silver, and then the bulks with the iron ore, lithium, battery metals, and then everything else, potash, other industrials. And as you can see, that initial top pie graph is very different from the bottom graph, which is the mining royalty sector by market cap. So this just shows where this sector came from. The genesis of royalties came out of the sort of 80s Northern American gold, precious metal focused market, where a lot were used to fund a number of these mines up in Canada and North America and South America to a degree. And you see there's a huge focus there on precious metal. We still see it currently at the moment. I mean, 10 years ago, I guess there were 3, 4 big, large precious metal royalty companies. Now there's 20 plus that are listed on various exchanges, but they still, if you look at our peer group, the vast majority of TSX precious focused. I mean, some will dip into the copper market now, but ultimately we do see an opportunity there. So like I say, a sector that's still dominated, whilst it's slightly, people are noticing, and hopefully they're noticing through companies like ourselves, but ultimately we're saying that there's still that gap there, and we see that on a regular basis in terms of the pipeline that we're having and the opportunities that come across our desks. And again, a lot of these are primarily focused on the TSX. We are, the only other London-based one is Anglo Pacific. Obviously, Wheaton's just moved over, but we still see, again, compared to those, we also of a size, a number of as I said, medium market cap of one of these companies is 400 million. So whilst we obviously want to get there, and we see a growth, we also see opportunity at the moment for strong, smaller size transactions, but something like Thacker Pass, but down to something like we did 8 million Aussie dollars on the Lake Rebecca asset, and that's going to be a phenomenal asset for us, and one that a number of our peers are pretty would love to have in their portfolio. So yeah, and we think there's still that gap in the market, and as I say, that this is what was planned at the beginning a year ago, and we feel like we're doing it. Obviously, certain as we grow, then we take on a bigger asset. Certain weightings of this global mining by sector compared to what we're doing, it will move. But when 6, 7 months ago, our weighting was very much iron ore and copper with our Australian asset and our Zambian asset. But obviously now we've picked up a few others, and it's changed it and slightly heavily weighted on the lithium side. But the next transaction will likely move that to some, even it up. And we'd like to think over the next few years we will start to see that balance out. We can't promise we'll hit exactly those percentages, but that's certainly a focus of ours. And then moving on to this, in terms of the approach, I don't think there's any rocket science here necessarily, and it's very much similar to the rest of our peers. We see that, and we feel it's a very repeatable and scalable business that we're running here. In terms of, as long as we're picking and choosing nice assets, we're not overpaying. We want to focus on quality assets that we believe either are in production at the moment or are going to be at some point a mine that is going to provide value to our shareholders and And I think we're starting to see that with as our portfolio starts to mature, and we can see, we're starting to get internal news and as these projects move forward. And I guess we obviously did a big fundraise, the most recent one, but we're now very much in talks to get some debt. I mean, we appreciate we're still a smallish company, so we're getting to a point where we have our 100 million revolving credit facility. Will take a little while, but we see that as very scalable once we start adding more projects that are going to provide a ability to service debt. And then in addition, the AIM market, we chose that for a very good reason, that we can see we don't want to use our script too often, but often you will see a number of businesses where there'll be a swap for a single asset, such as a royalty and an asset, and they'll swap it for our debt and for our paper and they'd prefer to use that rather than having their single asset on their portfolio. They get exposed to our portfolio. And then finally, I think there'll be some questions on this, and Adam will deal with it later. But ultimately, we do want to be able to return this, some of the money that's come in and the money that we'll be making into an attractive dividend policy once we've achieved scale. We don't want to hit the point where we're just paying a dividend. We want to still be growing, but equally we'd like to be at the point where we know we can return a yield to our shareholders. And I think, as I say, this seems like a very repeatable and scalable business, and we're very excited how the last 12 months have gone. Okay, on to Adam now. I think he was going to cover off the valuation, royalty valuation companies. He's done this a number of times, so over to you.
Yeah. No, that's right. I think many of you are probably invested in other royalty companies or have at least reviewed sort of the universe of peers out there. And one of the compelling things about royalty companies is the fact that they trade at these sort of premium valuations. And it all goes back to what Martin was saying in terms of the inherent benefits of royalties. The fact that you get the same sort of equity upside exposure, but from this risk mitigated position of not being exposed to operating costs of the underlying asset. You're just getting your cut of revenue. So as long as the mine operates, you're getting your exposure. If the mine expands, if it extends its life, you get to enjoy that as well as equity. But margins get compressed, equity suffers, the royalty doesn't at least quite as much. And for that reason, then royalties, you combine that with the fact that as a royalty company, you build up this size and scale such that you've got this broad diversification in your portfolio. But relative to a mining company, as you can understand, a royalty company, it has a lot of inherent benefits because of the nature of royalties and the diversification. So because of that, they trade, as you can see, at these sort of at a premium to mining equities. So the benefit that conveys with that is mining equities, you see their multiples increase, a little bit with the growth of the company. As you grow from a sort of single asset junior to a mid-tier with maybe 2 or 3 mines, you see a slight re-rating from 0.6 to 0.8 with regards to how you're valued by the market. The market will look at your net asset value and apply a multiple to that. And that's sort of the range around which you're trading, your shares are trading. Royalty companies get that premium because of all the benefits we spoke about. But then also as you grow and get more diversification, you see that re-rating grows more substantially than miners. So the benefit of that for us is that with each transaction we do, take Factor Pass, for example, we flagged that we see that as being an upper teens post-tax IRR type of deal on a long life asset. So that's a very nice accretive deal for all Trident shareholders. Your share is now worth more than it was before that deal, even despite the fundraising. So there was some dilution, but at the end of when the dust settled, your share is worth more than it was before. And that's our job. That's what we're supposed to do. The benefit of a royalty company then is with each deal, you're also getting the whole company re-rated as you go along. So each deal is accretive in its own right, but then with each deal, you're slowly marching up from being valued at a 0.8 to a 1 times, up to that sort of mid-tier range of 1.3, and then the very big boys, at the sort of peak gold price last year, the very big guys like Franco and Wheaton and Royal Gold were trading at 3 times net asset value. So it's this inherent benefit that adds real fuel to the fire with each deal. You're getting benefit, but then the returns get accelerated by the sort of re-rating premium that you see in the royalty space. And again, there's a lot of research out there. It's almost universal. So don't necessarily take my word for it. Go out there and a lot of material. Scotia does some good work on this, and do your own review, but it is nearly universal with regards to how royalty companies are valued by the market. So how we see this sort of playing into Trident specifically, I like this chart. It shows 4 of our precious focused peers, because there aren't very many diversified peers, and none that have sort of that are relatively new. They're all sort of older groups, but there are quite a few new precious companies. So Sandstorm is sort of 10, 11 years old, but then Mavericks, Metalla, Eli, they're all sort of in the 3 to 5 year range. So have done what we're doing very recently, obviously only precious focused. That said, as Martin said, that the strategic approach is effectively the same. You're building out this size and scale as you go, and that's what we're doing. And this chart here shows on the x-axis trading days since inception of their royalty strategy. So with one calendar year being roughly 250 trading days. So we're nearly at the 1 year mark at the moment. You can see us then plotted on there in the yellow line. We're in that process of establishing critical mass, and we're seeing that reflected in the share price. In fact, we're sort of trending to the upper end of how these peers have performed. That said, the real upside comes once you've built that sort of size and scale and critical mass, because that does unlock the ability to do a dual listing if you think it's accretive, to tap into lower cost debt. So as Martin mentioned, we're very close on a debt facility, but the intent is then as you continue to grow, you can grow that debt facility, but also the cost of that debt comes down. And again, look at the very big boys, and you'll see that they have revolvers with big commercial banks paying, LIBOR plus a certain percentage. So very low cost debt that allows you to continue to grow the company, but without doing sort of continual equity raises, because that doesn't do the share price any good, obviously. And then most importantly, commencement of a dividend. We're all shareholders. We're all here for the equity incentive. So the morning that we can announce our inaugural dividend is going to be a good day for all of us. And so that's very much the objective. But all that comes with building that critical mass, and we're sort of very well progressed, I guess, in terms of establishing that. And then the next slide just sort of zooms in on this progress as we've, since our listing at 20p in June 2nd in 2020, we raised 20 million US, and then from there was going out there and completing on some transactions. So we launched with 1 royalty, 1 transaction. We've dialed on 7 transactions and have 12 royalties. And importantly on this slide, obviously good to see the share price responding. That's what we're here for. But equally good to see the liquidities improving significantly, particularly post the Thacker Pass transaction. I think that turned quite a few heads. We haven't seen it sort of reflect in the share price the way we would have wanted necessarily. We're up from the raise price and from where we were when we did the deal, so of course that's good. But most importantly, we're seeing a huge spike in liquidity, and that drives a healthy share price at the end of the day. And it all comes back to it being a stellar deal. But I suppose the takeaway from this slide is that we're not done yet. We're not sort of sitting back and saying we've done enough. Now let's wait for these assets to turn on. The objective is to continue building, and as we go, we're going to see the liquidity continue to improve, and we're going to see, with each deal, we do see a response in the share price, and the name of the game is to build size and scale and to do deals. So we certainly anticipate doing more. So that's where we stand today. I'll hand it back over to Martin to just talk on a couple more points on the strategy, and then we will go through the portfolio and then jump into questions thereafter.
Thanks, Adam. That's right. Just a brief overview on the model as well, in terms of this being a low overhead model. I think we published the financial statements a couple of months ago now. I mean, that's the first year. There was a listing in there. It's slightly, we'll wait and see, but there'll be a steady state in terms of our expenditure at a certain point in time. It is a low overhead model. Unlike a number of miners, we don't have a huge headcount at all. We're a very small and well-connected team that work well together. And in terms of that cost control, we certainly minded to keep on top of it. But equally, our model with the royalties, obviously they're exposed to the top line. So hopefully our revenue will grow in future years as the projects that we like, the Lake Rebecca's, the Mimbula ramps up. We've got Thacker Pass obviously coming on board, so we expect to see that revenue line increasing. I mean, unlike a lot of our peers, our junior peers, we do have this revenue. It can be a tiny bit lumpy in terms of the assets that we have. But we do hope to see that our costs are covered over the year, so that any dime that we raise in terms of equity or on our debt, we can spend and deploy into actual projects rather than use of proceeds into working capital. So that's certainly the model we want to focus on. It can be a bit tricky sometimes, depending, as I say, on what the operator is doing. We don't always have full control over that, obviously. So, but we like to see, we like to see over the next coming years, as I say, that top line increasing and becoming a lot more steady state. One, as I say, to cover the basic costs, but also two, to get to that point where we can start paying a dividend out. I mean, as an example, obviously we keep reflecting back to these aspirational companies in terms of Wheaton and Franco and Royal, but they're massively expanding companies, huge revenue lines, market caps of billions, and ultimately, so I think it was either Royal Gold or Franco. I can't remember what Adam told me, but they still only have about 30 employees. So if you can think about that as a cost base, they're very lean and mean, and it's a model that we expect to reflect, and we hope we're doing that to a degree at the moment. But some bits are slightly out of our hands, but it's still, I think, a tight model. Okay, so moving on to the assets, I'll just hand back to Adam effectively, but this is a new map we put in. I think it gives a nice clear image of where we are. We obviously, as I said earlier on, we're not particularly jurisdiction precious. I mean, as I said, we won't go into anything that's much in the too hard box, but we're equally happy to go and look at something like we did in Zambia with the copper mine there. So I think we've already got, as I said in that graph, we've got a nice suite of commodities and jurisdictions. We'll continue to work on it. That being said, we won't be, if a good deal comes along, we won't be going, oh gosh, that doesn't quite fit the third. We will focus on good assets and good deals. So yeah, back to Adam, who's going to take you quickly through the asset suite, and then we'll move on to the questions.
Yeah. So jumping in, we've got more information on each of these assets in the appendix of our presentation, and this is the same presentation that's on our website. So feel free to jump into the detail later. We have tried to sort of simplify the presentation in terms of the material that we're putting in front of people on the specific assets, but the detail is in the background and quite a bit of information on our website. So I encourage you to jump into that, and I should have mentioned it previously as well. If you're not already following us on LinkedIn and Twitter and those sorts of platforms, we are pretty active, and we do put sort of operator updates out through those platforms, so you can sort of keep a finger on the pulse of how the portfolio is taking shape. But touching on some of our key assets, Thacker Pass, clearly our biggest deal. We raised 29 million at the time of the deal, and then deployed 28 for this asset. Of that 28, the seller took 2 million in equity. We positioned them to take more, but we were oversubscribed on the equity raise, and we wanted to get as many institutional shareholders and retail shareholders on the register as possible. So that was a good position to be in. But Thacker Pass, the quick overview is it's a lithium deposit. It's in Nevada, which is, per the Fraser survey for 2020, the world's #1 mining jurisdiction. It received its final key federal permit in January. As well as the operator of the asset raised 400 million towards construction. And the history of this royalty is important. So it was written almost a decade ago. In fact, it's probably quite high risk at the time, because it was an exploration asset, that was prior to permitting, prior to sort of lithium really getting traction with EVs. So there was quite a bit of uncertainty around this asset at the time the royalty was written. That said, we knew the royalty existed. We looked at it last year. It was held by a fund that has a fixed life. So, you've got a party that didn't have a gun to their head saying they had to sell right away, but they do have a timeline by which they have to sell. It is a closed-end fund. So as soon as we saw the operator of the asset get that final key permit and then raise the 400 million towards construction, suddenly it went from sort of one of many global lithium deposits to now a project that's moving towards construction very clearly. There's a clear path to first production. So although first production is a couple years away, you've got sort of that some certainty, or the the comfort that it's moving in that direction, which is really what we needed to see, because it is a big royalty over a very big project. So, it was going to be a big ticket regardless. But just wasn't a right fit for Trident prior to having the operation sort of jump over those hurdles. So as soon as it did, we quickly reached out to the party that held the royalty and put in an offer and tried to progress things forward and move pretty rapidly to secure the deal. In terms of economics, the royalty we acquired 60% of it, and it gets a little convoluted as I try to explain it to people, so I'll try to keep it very clear. It's an 8% royalty, and effectively the operator of the asset can pay $22 million in a one-off payment, and that knocks it down to 1.75. So clearly, if they have the capacity to do so, they would almost certainly do that. And the operator is a multi-billion-dollar listed developer. One asset they have is turning on next year, and the Thacker Pass will be following thereafter. And at the moment, they've got over $500 million in the bank, so very well funded at this point in time, anyway. And all their study work on the project assumes that they would buy that back, because as you can imagine, paying 8% versus 1.75 is a big impact on their economics. So we bought 60% of it for $28 million. If and when that buyback is exercised, we'd obviously get 60% of it. So effectively, that would put us on risk for $14.8 million, because we'd be receiving back 13.2 at that point in time. And I should point out the study for the project flags that before you sell your first shipment, you would want to exercise that buyback. So that's the assumption that we're working on. Of course, we'll approach the operator and see if we can't pull that payment forward. Take a slight haircut, but pull it forward, because we can certainly use that capital to deploy on other royalties. But effectively, you'd be on risk at that point in time for $14.8 million. The stage one, which is the one that's largely funded for construction and is permitted, would throw off at these lithium prices somewhere between $3.5 to $4 million on a pre-tax basis per year. And then stage two, which is also permitted and is intended by the operator to be funded via cash flow from the existing operation, the phase one operation. At that point, on the current lithium prices, it would be paying around $7 million to $7.5 per year. So you can do the sort of quick back of the envelope, or we sum it up here over the life of mine, including that buyback. It would pay us at the $12,000 lithium price, which is important to flag. Lithium's above that today, but at $12,000 lithium price, it would pay back over $340 million. So even if you just annualize that and roughly $7 million a year, you can do the math, and it's a sort of upper teens post-tax return, which you can look at peer deals. They're happy to flag deals in the sort of mid to upper single digits on a pre-tax basis, and tax is clearly important. So something in the mid to upper teens on a post-tax basis, I think we've got quite a few peers that are green with envy, because that's a fantastic metric. And I should flag the operation has a 46-year mine life. So you're getting that sort of return profile year after year for 46 years. The resource is twice the size of the reserve. So, either they can double the mine life if they convert that resource to reserve, or they can expand production along the way, it gives them quite a bit of optionality. And actually, one of the benefits of royalties is obviously once you own it and it's in place, you benefit from upside. And we already saw when the operator Lithium Americas put out their Q1 quarterly update, they flagged that phase one had previously been contemplated at 30,000 tons of carbonate. They're now contemplating 30 to 35,000 tons. So again, immediate upside to the royalty. They also flagged potential for a 20,000 ton a year hydroxide conversion plant. And lithium hydroxide versus carbonate, without going down a rabbit hole, they both have different uses in batteries. Hydroxide's getting more and more uptake in newer battery chemistries. And at the moment, anyways, it trades at a premium. So the Roscoe long-term forecast has carbonate at around $12,000 per ton, and hydroxide at around $13,000 per ton. So to have that optionality built into the project, whereas previously it wasn't, again, all benefits to the royalty, and our cost is fixed. We bought the royalty, so that upside accrues to us. So again, back to the benefits of royalties. So a very, very good deal, and we're really excited to have secured that one. Coulee Knobbing, this is the one we started with. I've got a soft spot in my heart for it, because it was our first royalty, and it's been paying since day one. it's a bit of a lumpy royalty. So it's a 4-pit operation, and it's the highest grade pit, the Deception pit, which our royalty covers the bulk of. And so, they do move around from pit to pit. So you see some oscillation. We're very comfortable with how it looks with regards to the life of mine, and even on an annual basis, we're comfortable with our projections. On a quarter-by-quarter basis, it's going to ebb and flow. But therein lies the benefits of royalties. This was, again, an existing royalty. This was held by a third party that used to own this property sort of 10, 12 years ago. When they sold it, they retained a royalty. And yeah, it's very much non-core for them. They're out, exploring for battery minerals in the Pilbara. So an iron ore property, although they enjoy the cash flow from it, it didn't do anything for them. It was off balance sheet. They got no benefit from the market for it. So happy to monetize it, get some cash in the door, and go do the exploration drilling they want to do on their properties. So from our perspective, to have secured a royalty for 6.65 million Aussie. Last year paid back over 2.6. As I said, some variability in that cash flow, but by and large, we're comfortable with where we see it on an annual basis, and life of mine certainly a really good deal in our objective, or in our view. And probably another thing important to flag on this royalty is, yes, it's a small royalty. Yes, probably not of interest to somewhere an Anglo Pacific or one of our other larger peers, because in US dollar terms, it was around 4 million at the exchange rate we bought it at. But that said, it's still a good quality royalty. Koolyanobbing is a big operation. It's operated by Mineral Resources, which is multi-billion market cap ASX listed operator. So just because some of these royalties are smaller, it doesn't mean that they're lower quality, or that you're constantly dipping into the junior market and getting sort of specky projects. You can still get royalties over good established projects operated by good operators. They just happen to be smaller royalties, so the dollar sizes are a bit smaller, but they're still very good royalties. And Koolyanobbing, I think, is proving that out for us. And I will pick up the pace because I'm conscious of time here. But I do want to talk about Lake Rebecca, because this is our marquee sort of gold royalty, and we do want to get gold into the portfolio. Comes back to that strategy that you've got the bulk of our space focused on purely precious metals. A couple guys doing anything but precious metals, and then nobody that does it all to provide sort of a full breadth of exposure to the mining sector from a royalty tack. So we do want gold in the portfolio. That said, it is the more competitive segment of the market, so we have to be conscious about how we're buying these royalties, because we see many peer deals done at effectively kind of no return, so that the return comes from mine life extensions or the commodities swinging up. And that's not the way we want to do things. So from our perspective, to get a royalty like Lake Rebecca, which is a 1.5% net smelter royalty, it's over the entire project, which is now over 1.1 million ounces. Again, shows the benefits of buying a royalty. When we bought the royalty, it was a 1 million ounce deposit. Just a few months after that, now 1.1, and continuing to grow as Apollo, the operator, continues to drill. And then they've got more holes being assayed at the moment, and more being planned for drilling. I have every confidence that this is going to continue to grow. And the operator, Apollo, is pretty aggressive towards, they've now kicked off study work. They flagged now some time ago commencement of construction in 18 to 24 months, which puts it squarely in first gold in 2023. So yeah, to have secured a gold royalty on an asset that's chugging towards first production within a couple of years. We bought it for it's about 5.5 million US. And at current gold prices, they flagged a 8+ year mine life on the current resource. The way we see it is 8 to 10+ years, and paying it at today's gold price sort of 2.5 to 3 million a year. So again, you can do sort of back envelope math, but upper teens, perhaps touching up towards 20% post-tax return. So yeah, again, we're able to find these gold royalties, and when we do, we pounce on them because there is more competition. But it all comes back to our peers are TSX listed, predominantly in the Americas, so a good quality existing gold royalty that can be bought by a third party, a little bit under the radar, on an asset in Australia, albeit by a very well funded operator that's aggressively moving forward. Just flew a little bit under the radar, I think, of most of our peers. So we're happy to secure that one. Warrawoona, another gold royalty. This one's not over the entire deposit. We've got an internal estimation of how much of the deposit we believe is covered by our royalty. We bought this, I think, very smartly. It was a low-cost deal, and it was 4 royalties. And this is a project that, although our royalty is not over the entirety of the project, it's in construction as we speak. Again, back to the benefits of royalties, we bought this in August, and in end of September, the operator, Calidus, announced that Macquarie was coming in for a debt facility, and they were now fully funded for construction. So yeah, their first gold is scheduled for, I think it's Q1 next year. Ours will not be in Q1 next year, to be crystal clear, because we're not over the whole project. But that said, it will be a paying gold royalty here in the intermediate term. So happy to buy that, particularly at the price we did. It was 800,000 Aussie, a chunk of that in equity. So preserving capital, building our portfolio while we did so, and all for sort of less than 500,000 US. Mimbula, really important to flag this one. So this is our paying copper royalty. A couple benefits built into this. This was the first royalty that we actually wrote ourselves. The operator was looking for some working capital as they were commencing their ramp up. They didn't want to, they're looking towards an IPO this year in London. So they didn't want to go out and do sort of a quick equity raise and sort of set share price expectations whilst in the midst of their ramp up. So they were open to a royalty, and we could move quickly to secure it. So we put the royalty in place to 1.25 gross revenue royalty. So for every $100 they generate, we get $1.25 of that. And then on top of that, because they are on ramp up and these things, they take time, they ebb and flow. We put in a minimum payment schedule. So at a minimum, it'll pay us 1.5 million US this year. That increases to 2 million next year. And then for the first 2 quarters of 2023, it'll pay another 1.5 million. So effectively, from the date we did the deal, which was June last year, we'll have recovered our capital at a minimum within 3 years. And so from where we're standing today, in just about 2 years, we'll recover the remaining of our deployed capital. And then from there, the royalty steps down to a 0.3 gross revenue royalty. And this is a deposit that's nearly 100 million tons at 1% copper, ramping up production. You can see why we did pounce on it, because you just don't see those kind of metrics every day. And it's led by a really good established management team. Senior exec from Rio Tinto leads that operation. They're very well funded. It's a private company, so I wish we could say more about it, but we'll have to leave it at that. It's very well funded, good operation, solid management team, commencing production, and a good paying copper royalty. So we're happy to see where this one takes us. In terms of copper, then our second copper deal that we did was with over the Pukakaka royalties. This was a package of 3 royalties, so varying rates associated with those 3, but effectively they cover the full Pukaha project, which is being advanced by Nexa. This is probably one of our longer dated projects in the sense that Nexa has one project in their pipeline that sits in front of this, and then Puka is next. Of course, that can all change if copper continues to go strong. Then this one, the economics might be compelling to make it jump the queue. That said, the risk is that something jumps in front of it. So that's, but that's why we got it the price we did. It pays. It's in the midst of its PFS right now, so it is being advanced. The operator Nexa flagged their budget for the project this year, and they increased it over last year. They put quite a bit of money into this over the last few years, so it's being meaningfully advanced. A good big copper project, and from our perspective, as soon as it turns on, there's a $4 million payment, and just a milestone payment. And then 12 months after that, another $4 million payment, and then we see the royalty paying about $6 million a year. I suppose more than that now at today's copper prices, but about $6 million a year at more conservative copper pricing. So in your first 12 months, between $8 million in milestone payments and then $6 from the royalty payment, we bought this package of royalties for $3 million in equity. So I'm happy to. If it takes a couple of years, I'm happy to sit back and wait for this one to go into production, because I think the returns would be pretty stellar when it does. And then in terms of revenue profile, you can see here this is based on broker consensus estimates. I should flag on our website, you can go to analyst coverage and read all the research reports and everything. You'll have to log in through their portals, but you should be able to register. And there's some good work that that both brokers that cover us have put out on the assets. You can sort of delve into the detail. And you'll see on here then in 2024 that anticipated partial buyback on the Thacker Pass royalty, hence that spike in that year. But effectively, what you see is from the portfolio as we stand today, we're marching up in our revenue with each successive year as assets continue to turn on. And we flagged quite publicly that our objective is to get to dividend yielding position, and we see that as occurring sort of when we get to a sustainable kind of 8 to 10 million a year in revenue. So if we did nothing more and sat on our hands for the next few years, you'd see that sort of commencing in 2024. Clearly, our objective is not to sit on our hands. We want to bring that forward. So we're looking at royalties and prioritizing royalties that we see as doing just that to both increase this revenue profile. We wouldn't turn away a good development asset, but also to bring forward that revenue profile. So royalties that are producing or very close to producing is sort of at the top of our radar. But you can see it's pretty material cash flow from the portfolio that we've already developed, and this all plays into value. I mentioned that Thacker, it's generated some good liquidity and some recognition in the market, and clearly most of the people on this call are shareholders and recognize the value that conveyed when you secure that royalty. And I think the rest of the market will be clued in as soon as they see that first revenue and as soon as we can initiate a dividend and those sorts of things. So I'm very happy to get exposure to what we're building right now, because the value is definitely going to be realized it's being realized as we go, but it's going to be very materially realized. That inflection point that we spoke about, that's going to occur, and you can see it on these slides right here. And with regards to pipeline, I always flag we're kind of restricted in what we can put out there. Obviously, these donut charts are all we're allowed to put out there in terms of trying to flag active NDAs, but the intent really is to flag to give everybody a flavor of what's crossing our desk as best we can. So it does sort of span the breadth of the commodities. We're quite a bit of base metals, quite a bit of precious metals. It sort of ebbs and flows, and then a good amount of battery metals and industrials. In terms of priorities, I'd happily snag a precious metal deal if it's got the good an appropriate return profile. Alternatively, I think a heavy focus at the moment on those base metals that overlap with the battery space. We see a lot of benefit to getting more copper, to getting some nickel exposure in the portfolio, those sorts of things. So that's sort of the priority at the moment. And then jurisdictionally, as Martin said, we're sort of wide open. We'll price in risk. It's got to have a good legal framework for royalties and all those sorts of good things. But yeah, we'll look globally and try to find the best assets that we can. And I won't bore you with RCVs, but all that material is obviously on the website. So I will skip over that, and that brings us to the end. I think probably on this slide, important to flag that we do have capital still to deploy. Still about 7.5 million, as Martin flagged. We're generating revenue, so we're not eating into that cash balance like many junior mining companies that aren't yet cash flow positive, that sort of have to do continual raises to keep the lights on. We don't have that issue, so it's a good position to be in as we bring capital in either through debt or equity. We can turn around and deploy that to build out our portfolio. So that's where we stand today. Good institutional support, cash to deploy, and yeah, performance today. Hopefully shareholders are happy with the way things have gone. We're going to continue to build out the portfolio, diversified geographically and commodity-wise, and try to continue to do what we've been doing, because it seems to be working.
Adam,
so with that, we'll turn it over to questions.
Brilliant. Adam, Martin, thank you very much indeed. And just let me just take those slides down. If you need those slides back up, please let me know, and I will bring them back immediately. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Adam and Martin take a few moments to review the questions that have come in already, I'd like to remind you that a recording, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, you'll be redirected for the opportunity to provide your feedback. Adam, Martin, we did have a few questions that were pre-submitted. I think you've touched on the one on the dividend. Perhaps I could ask you with the first one being, will Trident be issuing more shares in placings in the future, thus further diluting the current shareholders?
Yeah, I mean, the objective is, well, we're all equity incentivized, we're all shareholders here, so we want to protect the share count as much as possible because we don't want to wear dilution. And I suppose hopefully we flagged it or answered it partially in the presentation that as you grow, this business model is very, very leverageable. You can tap into debt to continue to grow. You know, that'll start with this facility that we're documenting at the moment, and the intent is that you roll that over and grow that facility as we continue to grow. And yes, there could occasionally be equity raises along the way to necessitate a deal or top up our cash balance we can continue to deploy. But you know, for the comfort of shareholders, I can affirm that we're very sensitive to that, and you know, we don't want to grow for the sake of growth and issue a ton of equity and find ourselves having a very large market cap, but the share price hasn't moved. That doesn't do anybody any good. So no, we're very conscious of that. So yes, the answer is there could be equity raises in the future, but we would only be doing it if it's accretive and unlocks a deal that adds to the NAV per share.
That's brilliant. And then the other pre-submitted question that we received was just around Peru, and are you concerned around the current political climate?
Yeah, I think there was another question as well, actually, just submitted in the live feed. I mean, the Nex are a very shrewd operator, I think, as Adam alluded to in covering the asset. It's a slightly longer lead asset than some of our other ones. So this sort of populist politics does come up occasionally, especially in South America. We're keeping an eye on it in terms of what it will mean if Castillo wins over Fujimura. It's not ideal, but equally that there's that this has been done before and said before, and it doesn't necessarily mean that when in reality they'll come in and they'll know that they need to keep the mining industry going to a degree, and decimating it with high taxes or royalties or nationalization is not a good incentive for inward investment. So sure, it's not ideal, but again, it comes back to also our portfolio theory. Sure, if we were our only asset was Pucaquaqua, then that's certainly become highly problematic. But we see it as maybe a little problem, but we don't view it, given the rest of our portfolio, having a significant impact on our valuation of it. And as I said, it's an extremely big, exciting project, and one that we couldn't see Nex abandoning purely because there's some political differences or difficulties. So sure, we're going to keep an eye on it. It's not ideal, but yeah, no panic.
Thank you. Well, thank you for spotting that one that came in right at the end about Peru. Yeah. I missed that, so thank you. So if I could ask you just now to turn to the questions that have come in the live event, if I could ask you to read out the question, who it's from, and where appropriate, give a response. Obviously, we're coming up to the hour, but please feel free to go through as many as you feel appropriate.
Yep, sure. Yep, so Milan P asked, environmental issues, Thacker Pass, any updates regarding the lawsuit? Yeah, so Thacker Pass, this is in relation to when they got their NEPA environmental permit. That was the big federal permit that I alluded to in January that really unlocked the project towards construction. And this was quite expectedly challenged. It always is in the U.S. I've got more experience than I'd like going through the permitting process in the U.S. And effectively, the stage right now, well, to set the stage, the operator of Thacker Pass, Lithium Americas, spent the last 10 years permitting the project, and there's a whole slew of state and local and federal permits that they have to get, and there's still a couple sort of state and local ones for water usage and those sorts of things, effectively to commence construction. But the big key final one was their federal environmental permit. They already had the state level one. So the final challenge at this stage, it can't be challenged on environmental grounds. Effectively, now the only challenge that an environmentalist group could throw up is that the NEPA process, the permitting process, wasn't thorough in some way, shape, or form. And obviously we got legal reviews as we were doing the deal, and have a lot of comfort that it was thoroughly done. As you'd expect, the Army Corps of Engineers runs this through a process. They do it for all kinds of projects, not just mining. We're not concerned about the environmental challenge. as I said, it's kind of clockwork. They get approval, groups challenge it. Notably, though, on Thacker Pass, given it's lithium, we haven't seen the big outcry from environmental groups. It's been a couple sort of oddball, mostly local groups, kind of not in my backyard type challenges. But people want lithium because including the environmentalists and conservationists, because it unlocks this change in power consumption. So I think clearly the Biden administration is very, very supportive. And in fact, they've created incentives to try to streamline permitting processes for key commodities for the battery industry. So yeah, it'll run through its process, but at this stage we're not particularly concerned. And in fact, now that they've got the permit in hand, the operator could commence construction, and if any challenge were successful, they'd have to they're allowed to recoup any investment they've made in construction. That's how far along the permitting process is. That now the onus has fallen back to the government if there was a sort of retrace, but we don't see that as happening. Let's see. How much? Richard L. asked how much in unused deal capacity do we have without needing to raise fresh capital. This is that sort of roughly $7.5 million that we've got in the bank, and then the debt facility that we're targeting and documenting is for $10 million US. So that we feel that gives us ample capacity to go out there and print another few deals. And then from there, it kind of depends on the pipeline. Clearly, it's easier to unlock more debt if you're acquiring producing or near producing royalties. So it'll be a little bit of a balance from there with regards to, thereafter, do you expand the debt facility or do you do an equity raise for the next deal? And we don't have those answers today, so it really depends on how we grow from here. But yes, ample capacity, so no need for an equity raise in the near term is the answer, I think. Let's see. Oz W asked, I hear market commentary that there's an abundance of lithium, so the price is unlikely to rise substantially. What are your thoughts? Lithium is one of these commodities where it's not rare. I certainly agree with that statement. There's lithium all over the world. What's rare is sort of having a good big concentration to make an economic deposit, and that's where Thacker Pass, being the largest reserve in the U.S. and one of the largest resources in all of North America, you get a lot of comfort that when you look at it, and in fact when we did the deal and put out the presentation associated specifically with the deal, we had a graph in there that plots it both by grade and by size of deposit, and Thacker Pass pops out as being one of the largest and highest grade in the world. And then particularly when you remove some of those other projects that are in sort of more challenging mining jurisdictions, China, for example, then it really does stand out. I've said it before. We like all of our royalties; they're all very good. Otherwise, we wouldn't have acquired them. Thacker Pass is the first one that it is truly recognized global tier 1 asset, and there's a reason for that. Very, very good position with regards to the asset. We take a lot of comfort from the fact that the U.S. is anticipated just within the next couple of years to have 100,000 tons in lithium demand, and at the moment we produce less than 5,000 tons. And all of the auto manufacturers have said they want to maintain their current manufacturing structure, which is vertically integrated within the countries that they're producing the vehicles in. So at the moment, they have to get their lithium. Typically, it's coming from Australia hard rock mines, more expensive to operate, being processed in Korea and shipped across to the U.S. So to get U.S. production to start to fill that gap in close proximity to their facilities, I think we talk to the sort of benchmark prices, but the reality is they'll be negotiating price directly. And shipping differentials and those sorts of things will play into that. So potential upside we see associated with that. Martin, I've been jabbering away, so maybe I'll let you do the next couple.
Okay. What is a typical time frame from first seeing an opportunity to signing on the dotted line, and what is the process? Like, I mean, I'm the finance guy, so I just sign the check. But it's these guys beavering away in the background. I mean, the answer is it varies. I mean, the Thacker Pass deal came very quickly, given its size and complexity. It was, I'm trying to remember, the end of January-ish, early February when they got their permit, and we started making some calls to say, hang on a minute, this looks great. And I believe we signed on the 19th of March, and for a size of deal, that's very quick, and there's a fair few all-nighters going on from Mr. Davidson over in Denver. So other deals, I know Cooley took a little bit longer when we first started, but again, maybe that was a process of being more of a junior company. I mean, we'd like to think, given our team and our experiences and our nimbleness as a company, we can actually, if an asset is or a deal can be done, we can be pretty nimble and quite quick to doing it. But I guess long and short, an opportunity come across our desk. We effectively do a desktop review with, sign an NDA, do a desktop review, get a feel for this asset. We might know the asset, we might know the counterparty, we might not. At that point, we'd be considering, is this a good opportunity? Have some dialogue with either the seller or the operator that we're dealing with, and then we'd enter into, if we did think it was good, talk to the board, potentially offer an MBO. I mean, that can take anything between a week to a month, and then once an MBO is done and they've accepted those terms, we'd potentially then enter into a longer period of due diligence where we're looking, very detailed diligence into ESG, geology, the finances, the counterparty, and obviously legals. So that there's a bigger deal obviously tends to take longer, but the process is very similar. And as I say, depending on how quickly the counterparty wants to do it, and often we want to do it quickly because this is a competitive space, not so especially in the precious sector. But I guess the short answer is it can take anything between a month and 6 months potentially, if not longer. So and deals can come and go as well. So with Thacker, we did look at it last year. It wasn't, it didn't have its license at that point. It wasn't something we felt we could enter into at that point, but it came back to us. So we feel all the work we do on something which doesn't necessarily happen can sometimes come back to us. So that right, Adam?
Yep, no, I think that's right.
Okay. Do you want to take the question? There's a question here on, please give further background information on our qualifications and track records. I think, as Adam said, there are bios on the website, not particularly flattering photographs. We need to get them improved. My background, I'm a 20+ year qualified chartered accountant. Initially started in a mid-tier assurance practice, was there for nearly 10 years, so rose to senior management level, at which point I moved to a consultancy firm that focused on mining and oil and gas. I spent 1.5 years there before I moved to a client of mine at that time that was a gold miner in West Africa to become head of finance there. Stood there for nearly 5 years before moving into a family office that was involved in mainly involved in natural resources before I moved to another West African gold miner called Tora Gold, which was a Senegalese gold miner, which was then sold to a mid-tier firm in Australia in late 2019, and then since then joined Trident. But yeah, general finance background with certainly a slant. I guess I'm the operator in the team. These guys are private equity background, along with Julian and Ty, who make up the rest of the team. I mean, I've seen the hard side in terms of costs and and dealing with equities in terms of equity holders. But I think I'll pass on to Adam to give a little bit more on his previous lives.
Yeah, I mean, prior to jumping into Trident Resources at the time when it was a shell company, I jumped in the fall of 2019. Prior to that, I had been with a mining private equity group for a number of years, both here in Denver as well as down in the Perth, Australia office. So I'd done mining finance deals, I think in all continents, save Antarctica, obviously, and across the breadth of commodities, everything from sort of the pretty vanilla kind of gold, copper type assets to more opaque mineral sands and bauxite and those sorts of things. So it had been a good sort of depth and breadth of experience, both geographically as well as commodity wise. And prior to that, I was with BMO Capital Markets, the Canadian bank, in the metals and mining equity research group. And before that was with Orica, mining and strategic planning. And I think our two other colleagues that aren't on the call, Julian Boucher, and who's our VP of Investments, and Tyron Reese, our VP of Corporate Development, both sort of similar backgrounds. Julian, prior to joining Trident, was with a mining one of we knew him previously. He was with another mining private equity group, and before that was with the IFC in their mining group. The IFC being the investment arm of the World Bank. And then I think started his career with Citibank's M&A group in New York. So a mining finance background, and then Ty and Reese. We were colleagues at the same mining PE fund, so made the move into Trident together. And he's a metallurgist by trade, and then did his Master's of Finance and CFA before going into private equity. So a combination of operational experience as well as mining finance experience. And then I won't go through given the time, I won't go through the board's CVs, but we've been very conscious, or the board's been very conscious about constructing a board that does have that full sort of breadth of experience. So mining finance, legal, technical. They've been very conscious of that. So it's we've got a good team here, and it covers all the key disciplines.
Yeah. The next question is regards to the Thacker asset. Does it cover the entire Lang package? The answer to that's yes. There's a current resource that's in the my model that fits into our near 50-year term mining asset, but there's also a larger area around it that could add to that resource reserve, and the royalty covers the whole entire package. In terms of any delays to the project, no is the answer. In terms of that, the royalty is on revenue, but at the moment the company has Lithium Americas has raised over $400 million to commence the production, the construction of this asset. They're still working through the PFS, which hopefully is out this year. The big mine constructions can be delayed. There could be a little bit, but we're very confident at this stage that this is going to be a mine, and it's going to be an excellent revenue generator for the company. So we'll keep, they're a listed company, so they obviously you can keep an eye on. They put out quite a lot of information. There's certainly some upside there as well that they've been talking about recently, but we'll also keep the shareholders informed as we see their development. So it's a great asset. It's long and short on that one.
Yep. And then the final question. And to flag, we did receive some other questions. Some are more appropriate for the actual AGM. So, things on management remuneration or strategic goals of the board, we'll let the chairman address those at the AGM. That's the appropriate forum for there. So, but we will get to them. So the last question that we'll answer today then is related to the pipeline, just asking where the pipeline comes from. And the short answer is it comes from a number of sources. Some deals have come from within our own networks. We've obviously been involved in mining finance for some time, so we get a lot of opportunities thrown to us from contacts we're aware of. The board has obviously got their own networks as well, and they get a number of opportunities thrown their way. Importantly to flag, the brokers that have been assisting in raising the capital, they're obviously mining focused brokers or resources heavy brokers in most cases, and they get a number of opportunities across their desk of mining companies looking for financing, and so that they're very much helpful with regards to passing those opportunities on to us. And I always like to flag Ashanti Capital, Zor Capital, and Tamas's partners, when they raised the original IPO funding just about a year ago, took the entirety of their fee in Trident equity. So they didn't take cash out of the raise, which is the typical process. The broker gets a cut of what they raise, but they took theirs entirely in equity. So they're incentivized and good groups to work with, and very, very supportive. So between the board, management, our supportive brokers, and then just general brokers, in the space reaching out, particularly following Thacker Pass. People saw we did an oversubscribed equity raise. We did a big $28 million deal. I think not only did the deal turn heads and that it was, a nice transaction, but I think a lot of people suddenly realized that Trident can do some chunky deals, and we can move quickly. We can do all those sorts of things. So I think we've seen the inbound opportunities sort of escalating following that transaction. And as we continue to grow, I think that's probably going to continue.
Adam, Martin, I might just jump in here, just seeing as you've been so generous with your time, and thank you to the investors that submitted the questions, but I think you've gone through pretty much everyone that's there. And maybe it's now an appropriate time just to ask you for a few closing remarks before I divert investors to provide you with feedback.
I'll just go first, Adam, with a reminder to everyone. With obviously the AGM, this was run now because obviously the AGM is now a closed shop at the moment with COVID. I mean, potentially could be done in person in a few months, but we wanted to get it done. So we wanted you guys to give you an update here and have an opportunity to ask questions, some of which we've answered, some of which we'll answer at the AGM. But yeah, there's another webinar effectively on the 8th of June, I believe at 2 p.m. And also, if anyone, obviously we sent out annual reports and the AGM notice together with proxy votes earlier in the month. So if you haven't voted, please do so. Just one thing to note on that: you are able to email the registrar. You don't have to send it by post if you don't want to. You can just email directly to the registrar with a scan of your proxy vote.
The only thing I'd like to do is echo my thanks for everybody's support over the last year, and you can reach out to us through the website. We do answer everything we receive, so if there's any follow-up questions, don't hesitate, and continue to look forward to some good news from Trident, hopefully in the next year.
Adam, Martin, thank you once again for updating investors today. Could I please ask investors not to close this session, as we will now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a couple of moments to complete, and I'm sure will be hugely appreciated and greatly valued by the company. On behalf of the management team of Trident Royalties PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good evening to you all. Thanks once again.